What about sectors, themes, ideas, and what could be the next big thing market should really focus on? To discuss all that and much more, I have with me market veteran Jayakumar. Jake, fantastic to have you back, and thank you for joining us.
Thanks for
Let's start me with your aggregate market assessment. This market surely has once again climbed the wall of worry.
Well, I don't know if it's a wall of worry really. We've basically gone from an earnings sort of expectation that was on the high, which kind of 2 quarters ago kept faltering, and then the market moved up to 11,300, 400 well and truly before fundamentals could catch up. Inevitably the correction happened, but the correction was far steeper in the space that most public is in, which is in the small and mid cap space, and so few stocks have actually retraced to new highs, and many of them happen to be in the large cap space. So the way I would say is, it's not so much the market correction was overdue, because your IPOs across the board were getting oversubscribed many times over at valuations which are absolutely absurd. Number two, you had A, B, C, all kinds of stocks moving up, with scant respect for fundamentals, if you will. So I think the market correction happened, and then the worry happened because of price action. Worry didn't happen because of the economy or otherwise. And over a period of time, the macros have led to improving micros now. So the improving micros clearly indicated that a floor was put in place just below 10,000, and even on your show last, I think we called the fact that 4-digit Nifty would be difficult to sustain. So that's held out. But as we speak right now, the market's virtually climbed, 2/3 of the entire fall it has retraced. So the way I would see right now is, this is a very discerning market. So you have, for instance, there are stocks that hit 60 and 70,000 crore market caps that today are struggling at 10,000 crores. No price for guessing names, but where a good bull market is one where few stocks make new highs. People are still hunting for value. They are scared getting into the frontliners, and those that are throwing darts at the small and mid caps, which are hitting new lows with gay abandon. So in some sense, it's a very discriminating market, and it's a market that we should not confuse for a across the board bull market. It's a stock pickers market. Very clearly, make no mistake about it, it's a stock pickers market. It's a market where at some level you're swimming with the sharks. So you need to be clear that in the same space there'll be stocks that hit new highs and stocks that hit new lows almost with equal alacrity. So from a sort of market perspective, I think it's a fabulous place to be if you're a stock picker. Leave the Nifty alone, and going back to again our conversation of last time, you will have a scenario where public will be well served putting 50, 60% of his portfolio in good index equivalent funds that move up maybe 10, 12, 14, 15% a year. And it's not impossible. They may not go up in a linear fashion. And use the balance 30, 40% for the mid-cap play. Because if you're otherwise going to be, if you're not a professional stock picker, then to be in the market, in this market trying to make money, whether trading or otherwise, is going to be very difficult.
Fair point. So I'm just going to first address pockets here. And since we are recollecting our previous conversations, we discussed aviation extensively.
Right.
And Indigo numbers are an eye-opener in a sense that the aviation sector may be growing, but crude is the biggest variable factor. I mean, I thought for a moment that it doesn't matter where crude is going because Indian aviation industry is enjoying pricing power. But for the quarter gone by, Indigo has admitted that, look, crude is important. Let's watch out.
Well, I think that's the subtext. If you see what has happened is, this sector has grown at a rate which is completely in dissonance with the way the economy is growing.
Of course.
It's grown at, in some months, 20, 25%. Now, if you go back and figure out what's happened is that as capacities kept growing, the industry players kept prices at levels which were even comparable to, I mean, pardon my the bus ride between two, 2 points, as it were, definitely competitive with rail and significantly more comfortable, etc. So really what happened is that now traveling by air, if you just take the experience, there is no airport which is today not chock-a-block. Airports are today catering to, a tweet the other day I saw which said that the Kanpur airport, for instance, is catering to 4 times the load it can actually take. And in the morning the queues actually lead virtually up to the car park. So if you look at those kind of anecdotal evidence, what you're basically saying is that along the way, crude kept going up, prices never kept getting passed, and what you're seeing in Indigo are lagged results. So without getting into the stock specific, I love the space because I think the pricing power has come in because traveling by air has become habit formation. today very, very few people will consciously choose anything other than air travel if that was available. So the way I see it is, results are a lagged indicator. Pricing power has returned. Now, I'll just give you one more thing. 10 years ago, we were traveling Delhi-Bombay economy at 8 or 9,000. 3 months ago or 6 months ago, we were traveling Delhi-Bombay economy at 3,500 and 4,000. Makes no sense.
Makes no sense.
Now, you go back to simple Make My Trip or any of these apps as of 1 month ago, rates are back up at 8 and 9,000. The pricing power has returned to my mind April, May, June. You will see significant revenue and yield increases, which you've not seen so far. And I think the growth will come down to 10, 12, 15%, but that's good. Load factors don't need to be at 98%. Just imagine, airports can't take more people, flights are going chock-a-block, aviation companies are doing 94 and 95% load factors. What has to follow is pricing power.
But Jakes, what we are today, making a view, what markets are making a view are based on Indigo's numbers for the quarter gone by.
Yeah.
This is April, almost May now.
So there's a consensus sell call today, right?
Exactly.
Which is exactly the time that good individual stock, and I'm not recommending, I think the aviation space, to make entry into this, you need to get into this mass consensus sell calls. Those are the days when you need to make your entry.
Would you be happy to allocate 8-10% of your portfolio to aviation, maybe a combination of 2-3
maybe
stocks?
even higher.
Maybe
it's a consumption, consumer-facing company space. Become habit formation. Airports are growing, infrastructure is growing, and the air travel experience is fantastic. Airport today, people would be happily be willing to wait at an airport than wait at a railway station. So, given that kind of a thing, where is the question? Don't look at 1 quarter numbers. And if in 1 quarter a single company result can take it down by 20% or 25%, where else do you get good entry points?
Fair point.
And I want to make a disclosure, I don't hold Indigo, but I think the space, I own stocks in this space and I don't want to talk specific stocks, and I love the space.
Markets are betting on a domestic recovery, a cyclical recovery. And typically when the bent of the market is tilted towards a genuine economic recovery led by capacity expansion and rural demand coming by, you would imagine that cyclicals should be toast of the town. But cyclicals are not doing all that well as markets were anticipating them to do.
See, I think the take here on this is that anything that is infra focused, because that's where the biggest action is. So we are very bullish, for instance, on the road infrastructure space.
Pure EPC companies.
Well, I would say a combination of EPC and toll companies. I think that combination, the activity around, you travel the countryside, that activity is there for everyone to see. And today with InvITs, etc. coming, these people are able to, in a sense, get debt off their balance sheets and deleverage themselves just as efficiently. So I think these companies will show growth, will show very good top line growth, and possibly with efficiencies coming in, managing number of toll roads, etc. I think they will show very good growth. So if those companies are not seen as, pardon the expression, sexy, but that's where numbers are getting made. Or for instance, just construction and contracts, which are being awarded, let's say in UP, the entire expressway network, which the Chief Minister has talked about, or in the Kashmir Valley, for instance. So few companies that can actually operate in these terrains. And some of these companies today are, quoting at ridiculous valuations. These same companies had market caps which are 8 and 10 and 15 times higher in previous bull markets. So I think that cyclicality will come back in stock picking.
But where do you think there's leadership in this bull market?
I think leadership will keep shifting. I think the thing of the IT space, which had receded into the background, literally in 1-2 month period, it's come back with a bang, and it's gone into territory where you could say it's not particularly cheap. Now the challenges lie ahead, but it's dramatically increased its percentage in the Nifty basket. Then you look at the banking space, which has got beaten up, but now 3 or 4 private sector banks have suddenly taken leadership, and whether it's HDFC, Kotak, etc., or IndusInd, they're occupying a disproportionate share of the banking Nifty. So if you look at it from that perspective, leadership will come in as some of the larger players become larger. But I think the opportunities even here could well be in the PSU space, because I think virtually every bad news has hit. Yes, I think the big challenge in the PSU space is that growth as a way of life, or lending as a way of life, has taken a big hit with all these inquiries, etc., which is like a witch hunt which is on. And I think that's a worrisome thought. So if that growth doesn't come back, yes, they may solve their problems, yes, they may send things to NCLT, which is, by the way, an area that I'd like to speak on. You will have problem resolution, but what about growth? And I think that's where PSU banks suffer right now. The growth and the way of life is getting taken up by the NBFC space and the private sector space, which is effectively stepping in where these people were lending in the past.
Now there is some confusion about how should one approach NCLT stocks. Now Bhushan or Bhushan Steel or Bhushan Power is going to see a rebirth. There are a lot of other NCLT companies which will see a rebirth and the business will move to a stronger promoter. Does it make sense to bet on some of these individual NCLT stocks?
See, there's a big clarification that actually SEBI has not made, which is whether public shareholding at 25% will remain and who is categorized as public shareholding. So what happens is that the traditional bankruptcy in the West, etc., which is why there is no one answer for everything. But the traditional bankruptcy said debt was going to be haircut. If there's a haircut on the debt, then equity guys get nothing. That is fundamental truth. But look at the companies that have gone into NCLT. There are a few cases like Binani Cement. There are a few cases like JP Infra where the stated position of the lead bank in terms of the valuation report submitted by them is higher than the debt value. That means by definition there is an equity value. So the first question I would ask is, why were they taken into the NCLT in the first place? Was going into NCLT really the way? If that was a way to enhance the recovery, and if debt guys are getting their entire amount, then by definition equity guys will. So I think we need to be clear that all cases referred to the NCLT are not cases where the debt guys get a fraction of their money. So where debt guys are getting much more, or their full and their complete thing, then the enterprise value has an equity component left.
That changes completely.
So why are we putting everything into the same basket? So I actually strongly urge, market commentators otherwise not to say that one rule, anything that goes to NCLT, equity value zero. Absolutely incorrect. There can be nothing further from the truth than this. And number two, what is the purpose of the NCLT? Is it for resolution or recovery? If it's recovery with a view to maximizing the debt holder's stake, then by definition at some point in time the equity guys too should have a say, saying once you guys have got what you have to, then we should go to somebody who gives higher value to the equity people. You can't just say the money is putting in is going to dilute us to zero. That doesn't make sense. And today SEBI has made it very, very clear, and I think the rules will change, whether the money coming in from the new promoter can take the equity holder, the promoter's stake, to beyond 75%. It's not very clear. If you want to remain listed, which is by definition what you need to do, or you go through a delisting process which is over and above the open offer that comes in. So the takeover rules today don't apply to an NCLT case.
From a bank standpoint, if you're a lender, let's say if you're an SBI or a PNB or a Canara Bank was given money to some of these NCLT firms, is this that moment of turnaround because money comes back into the balance sheet?
Well, for starters, the first 12 cases that have gone in, all steel companies and one or two other companies, the money that's coming back is well and truly beyond what was envisaged. Exactly. And certainly a part of the provisioning may even be written back.
Yeah. And so that is something markets are not talking about.
But most importantly, these are non-performing assets on their books. If the resolution happens, the same money starts actually performing, either in terms of money coming back or being lent to somebody else, or the same money now yielding a certain positive carry, which I'm saying whether in the NIMS calculation otherwise is not being factored in. It's being taken as a zero yielding asset today with a provision. So that turnaround is a very sharp turnaround which you will see in the numbers, whether 2018-19 for sure and 19-20 almost guaranteed.
Jix, over the years I've interacted with you, what I've always admired about you is the ability to think different, out-of-box thinking. You like to go to a place where there are fishes and where fishermen have not reached. So where are you hunting in this market? What's your slightly offbeat, out-of-box idea?
So I think the NCLT construction companies, without again going to specifics, because we have stock ownership and I have personally, is an area that I have kind of alluded to in this, that there are companies where the total enterprise value as given by the lead banker and the valuer is much higher than the debt. In those cases, if you're getting equity almost for a pittance, it just makes no sense for us not to look at those. And again, I believe some of the big returns in life are made where people fear to trade. So to that extent, I mean, I like swimming with the sharks, I'm there, but a percentage of the portfolio. I mean, with the passing of years, as it were, a lot of my portfolio is also in relatively safer stocks, but I will still keep 40-45% of my portfolio, which is a high number, by the way. Others may be happy with 10-15% in areas which require a lot more deep diving, a lot more thinking through. Talking of which, I want to leave one big area which I think viewers will find it interesting. Over the last 30 years, if you see the people who've been, and I'm one of them, by the way, an engineer, who's moved away from engineering because the engineering space, whether in terms of profession or in terms of investment, was just not attractive enough. So over a period of time, and with the rupee not sort of secularly weakening as it were, or to the extent it was secularly weakening, there were exports. But the domestic engineering space kept sort of being seen as the space that was being constantly squeezed for margins, etc. These guys were known for low capacity utilizations, only cutting costs to keep their margins going. Over 25-30 years, guess what's happened? Actually, the Indian engineering space has come of age. Today, in the engineering space, where the hydraulics, which is one space we track, or in machine tool industry, the capacity utilizations are at 100%. Costs have been cut to bare bones. I mean, you can't have more efficiency being driven. In addition to these, you have order books which are not 1 month and 2 months, but now 6 and 8 month order books. So if that is the scenario, the operating leverage for these companies
is going
to be fabulous. So the engineering space people are not looking at. I think that's a space that we kind of like, especially the Indian engineering space, the first generation of them. Many people in this space who have been noticed have been the auto ancillaries, because those have been keeping pace, and they, by the way, there's a lot of inexpensive stocks available out there. But outside the auto ancillaries, in the hydraulic space, for instance, you will find companies that are very, very attractive.
There are two more follow-up questions, and I'll sort of take the global linkage here. FANG stocks. I mean, that's where the action is, that's where the wealth is, that's where the market cap is. An average Indian investor cannot buy these FANG stocks, but has desire to participate in this wealth creation which is happening overseas. What is the best way to chip in and dip your toes?
Well, I think there are mutual funds like ICICI Pru, etc., that have schemes which specifically invest in NASDAQ-oriented companies or companies which are the top 100, the large caps in the US markets, and I think that's the only way to do it. So you could put aside a small amount in the LRS basket, essentially, which in these funds, and allow them to grow. Of course, the valuations are high, but the way these FANG stocks are getting valued today leads me to believe that people are seeing this as business models with unlimited upside and limited in terms of cost, because the reach is technologically sort of been made more amenable, that your costs don't go up as much as your revenues can, and margins therefore keep expanding. So in this, if you notice, Apple gets the lowest multiple, and that's because it's seen more as a company that is selling products than services in some senses, because they keep talking about how many Apple, how many iPhones sold, how many iPhone X's, etc. But if you look at Amazon, for instance, never raised money, kept redeploying its surpluses, and on track, to my mind, to be the fastest first $1 trillion company, even ahead of Apple. So the way to do it is actually investing through some of these funds, because that's the only way to do it. And you also get a diversified portfolio rather than concentrate on 1 or 2 stocks.
2 weeks ago, TCS was wearing the crown of being for India's first $100 billion IT company. Reliance 5-6%, and it could also reach there. Which are the other companies do you think will make it to the cut?
Well, I think inevitably banking will. I mean, and I think, to my mind, the next in that space will be a banking or a banking financial services company. That would be the next to make it. Retail still has got a long way to go. So in terms of developed, I would say banking and financial services would probably be the next, maybe another IT company too, but the next IT company is far from here. But I think consolidation will tend to make some of this happen. TCS is remarkable in as much as been organically driven. It's hardly had any acquisitions as such. But that's the way I would look at it. Maybe consolidation in the banking space will start creating bigger and hopefully much larger players.
It may be an old theme, but is the reason to associate with Tata group of companies with the change of chairman there? Do you think capital efficiencies will take over? There is some evidence of it, there is proof of it, but there is no trend in making.
Early days yet. I think things like efficiencies, efficient use of capital, yes. I can see that as a stated objective. It's not something I'm saying, it's something that Chandra himself has gone out and said, and I have no reason to believe that his pretty simplistic, straightforward approach will ensure that it were to happen.
And he knows how to run a tight ship. He comes from the IT background. He's been sitting on cash and never destroyed it.
Culturally, professionally, he comes from a background which is driving efficiencies all the time. And I think some of the people that he's got in the operating companies also operate similarly. Titan is a good example, and I'm sure there are others which we can talk about. But I think clearly that is going to be the order of the day, which is better capital. Otherwise, what happens is people have been uncharitably saying that when they need money, they sell X amount of TCS. But that's an uncharitable way of putting it.
Jakes, you've seen many cycles, boom cycle, bust cycles. You've pretty much, shaken all the market rocks, and you know how to judge a company. Now, if I had to take the clock back at the beginning of your career, 1980s, when you started your career and you started association with capital markets. So if Jakes of 2018 meets Jakes of 1980s, what would be your advice to that person? How should you approach capital markets differently?
I think capital markets, I think the single biggest takeaway will be that trends that start tend to surprise you in terms of the returns they can give in the markets. So we, for instance, at that time, if I had got a stock that went up 50 or 60%, I'd be very tempted to say, take your profits. Over a period of time, we started talking about doublers and triplers. But actually speaking, investing can be simplified when you say that if there's something good, go back to the old American adage, right? If it ain't broke, don't fix it. Yeah. So if a portfolio is doing well, why do we need to sell to buy something else? So the Jakes of 2018 looks back and says, had he held on to a lot of the stuff that he had, I saw the IT thing because I was an engineering student. Number of my peer groups were in the early space. In fact, one of my classmates, who's no more, Rajiv Motwani, actually was the mentor for some of the for the founders of people like Google and so on and so forth. So his founder shares today are worth much more than what people have made in multiple generations, if you will. Yeah. So at that particular point in time, you look back and say that it's a company that's growing, management that's straightforward and continues to communicate. Then why do you believe that there is a time when you need to exit and get back into something else and recreate the same discovery cycle? You don't need to. You just stay on with it. So investment can become boring, but sometimes the boring investments do very well in life.
So which is one stock you regret selling late, and which is one stock you regret selling very early?
Good question. I think I would say I used to hold Infosys. I used to hold one or two other tech stocks, and I think I sold Infosys early. That's one thing I would definitely say. I didn't see it in 92. I saw it a little later, but then it still was 2-3 years away from the stables, as it were. But I think I sold that early. Couple of banking stocks which we actually got into, where I, for instance, did not think that banking would compound the way it has. So that's so I would say a couple of banking stocks where I would put myself as regretfully having sold early. In terms of selling late, I don't know. They can be sold a few things which pretty close to the end of the cycle. So I would just say that one has been fortunate. Not sure about late, but difficult to say. I'm not sure.
Difficult to say.
Yeah.
Okay. But if I have to summarize today's interaction, would you say that your prediction on the last show was that a 4-digit mark for Nifty is not going to sustain for a long time? Yeah. Can I say for the better part of this year, Nifty will spend time in 5-digit?
I think so. I think so. And I think it may be a very narrow movement. People have been used to high volatility. I think the volatility may be there, but the overall range for the year may be pretty narrow.
Okay. I'm looking for that kind of an answer. So appreciate your time. Glad
Thank you. Thank you so
much.
Thank you very much. Thanks for having me over.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.